I remember this was our last slide that we seen, and it's all about. Please confirm this is the same question that we are referring over here. Okay, from any one of the participants would like to come forward and volunteer himself to solve this question. Mr. Khalid and Maulana Ashraf. Mr. Khalid, would you please unmute yourself and start this?
Assalamu alaikum, everyone. So you can hear me?
Yes, please.
Sir, in this question, our adjusted EBITDA is 180 million, and we have net interest expense for expenditures is 80 million and income is 60 million. So our net interest is 20 million. We will go for our interest capping rule, which is 12 million or 30% of the adjusted EBITDA, whichever is higher. So if we go for our 30% adjusted EBITDA, it will be 54 million of 180 million, which will be 30% of 180 million. And our expenditure is 20 million. And we have last year's 11 million losses, tax losses. So if we go for the capping rule, we have allowed 54 million. But actually we have for this year only 20 million. Plus we can also based on FIFO method, we will current year's 20 million plus last year's 11 million, total 31 million we can take as our interest expense current year.
Okay, thank you. I think the same we already did in the last session, or maybe the last moment we skipped that something. But here is the answer, and this is the same that just now or one of the participants is answered on that. So I'm believing I'm understanding now so far the understanding of all the participants of this session is appropriate, and they are able to understand what we are discussing in this course. Anyhow, let's move to the next. If anybody have questions, so please let me know, or we are moving to the next. And before that, I would appreciate if anybody volunteer himself. There's some key notes in this interest capping rule we discussed. And somebody note down during the session, or he will written somewhere. So he would like to come forward and volunteer himself, so he can explain these key notes. What are the key points or the key notes we have to keep remember while solving the interest capping rule? Okay, let's go back to the couple of previous slides. Okay. So this slide basically whatever we learned under interest capping rule, so this is addressing to the same part. So here is a summarized keynotes that we have to remember that, and that will be helpful while doing the interest capping rule. The whole story of this relevant article of City Law 2931, the crux or the summarized version is here. We already learned all of these points, but I appreciate if this point also you can note down or make your keynotes and keep it with you. It will help you for an interest capping rule, you will apply easily if these keynotes are with you, because the concept we already gone through, the understanding we already have how to apply. Now the summarized version, how to keep the keynotes. Interest capping rule. So interest capping rule, the first point that we seen. Now we are saying that not interesting interest capping rule applied on which taxable person. We discussed in the previous session also. Ms. Farhana asked one of the question. So interest capping rule will not apply on which taxable person. So bank, insurance provider, business by natural person, or any person specified by ministerial decision. We go through the banks, insurance provider, and natural person, and any specified for the ministerial decision. Guys, do you have anything that is not clear to you on this point? Because I am expecting this point would be already is very much understandable to everyone. Would you please make comment quickly? I appreciate if all of you guys be active and quickly respond on that, because we will move forward to the next topic. Okay, now the next bullet. Now here we are discussing what are the interest key points that we have to consider. Next point, expenditure. Net interest, the definition we learned in our previous sessions, the net interest. What is the net interest? The net interest, the expenditure, interest income minus the interest expense. So we may have the some interest expense in even the now again we seen the just previous example. There was 80,000 and 50,000, 80,000 interest expense, and I think the 60,000 or the 50,000 something was the interest income. Net of we have 20 million is the interest expense. Hope this point also is clear. Let's move to the next. Interest include other cost of. So now we have to see what are the other costs can be considered under interest. While doing the interest capping rule, which are the other factor we have to calculate under interest? Debt financing like arrangement fee. So how many participants are the people in today's session? They are having or they are working as a finance controller or the finance professional in any form of the organization or any form of the, the professional working. Would you please anybody volunteer himself? Anybody working as a finance controller in any organization? Okay, now I'll give you the example. If you arrange the facility, the finance facility from the bank, I'm giving you the example, one of the simple example that mostly the being a accounts person also we go through that as in our bookkeeping part or the accounting part or the classification part. We are making the appropriate classification of the expenses, whether this is the interest or this is the another part of the expenses. So if any company take the bank facility or the bank loan, so there will be two kind of the expenses. One, the facility arrangement fee. The facility arrangement fee normally they call the service fee, because bank work with you with any of the company and to arrange to work to analyze to prepare the document to proceed the internal credit analysis, because normally we are familiar with the relationship manager. So in terms of the facility from the any financial institution, there will be a relationship manager that will be allocated to the company. So he will go through all the company documents and he will take all the relevant document, and this The RM will be our point of contact with the bank. So he will knows our nature of operation of business or other kind of the stakeholders or the shareholders, whatever kind of the information correlate with the business. So he will be visiting the company. He's discussing with the finance manager, or finance director, or finance controller, or the owner, whoever is coordinating the point of contact with them. So he will arrange the all the documentation, prepare the case, and submit to the bank credit department. So internal credit department, he will review and he will proceed further for the allocation of the facility or risk analysis. What are the, because each company, the interest expense will be differ. It will not be the same. If so far anybody is not working the facility arrangement, the finance person, so he also can understand the same concept, because how this will work. Or maybe your company is looking for the finance facility, so you can support them by considering the same principle. So you have to prepare the internal management financial as well the audited financial, and plus the forecast for the next 3 to 5 years. Considering all this, you will prepare the document and give to the relationship manager. He will proceed the internal discussion with the credit department. So the whatever the activity this relationship manager is doing, because he's taking the document and giving to the credit department, so he's doing the arrangement between the bank and the company. If the facility is approved, so they will take normally 1% to 3% in between based on the each company and the risk factor and amount of the facility. Whatever the facility is secured, so they will charge the average, they are charging 2% of the facility amount. Like let's say you have the 5 million, the facility LCTR, in which you have the guarantee amount also. The guarantee is a performance guarantee, advance guarantee, tender guarantee, or any kind of other guarantee that fall under that. So these two kind of the element will be part of the interest, because even he work as a finance, because it's a finance cost. So here we have to understand what is the interest is not only that you will pay on the borrowed money. To have the arrangement of the borrowing facility is also the part of the interest cost. Hope this point is clear. I explain in very detail and concept. Hope you guys are clear. Please quickly respond. Next, let's move to the next. Leasing finance cost is a deductible. Yes, if we have any kind of leasing arrangement, asset lease from the bank, or any kind of other plant or machinery is leased from the bank, building finance is leased from the bank. So these are also part of the interest capping rule. So this will be calculated under the interest capping rule in the same fashion. So now the next point, again, this is the another critical point you have to understand. So this point, capitalized finance cost is deductible only the amortized, only the, what is the capitalized finance cost? If any of the participants would like to volunteer and explain what is the concept of capitalized finance cost and which accounting standard or IFRS dealing with that. Borrowing cost IS 23. Now the latest is the IFRS 15 is the revenue. Latest IFRS 15 is the revenue. So what is the latest IFRS for lease? 16. Thanks, Ms. Yes, IFRS 16 is dealing with the finance leasing. So now here the point is that we have to apply the standard appropriately. What is the standard requirement? What is the standard requirement? Some asset like the building structure, that company is purchase the land and start manufacturing, constructing the warehouse or the factory for the own use. So what will, and he borrowed the loan from the bank. So how much the interest cost will be a part of the capitalized and how much will be expense out. So the whole story will be here. So if the finance cost can be capitalized as part of the asset, so that will be go to the interest, the balance sheet, and whatever the finance cost cannot be capitalized, it will be expensed out in the same year. So now here the point we are going to understand that now our balance sheet item where we have the original cost of the building plus the finance cost that we paid to the bank as a finance cost. So there is a two element of that finance cost. One is a capitalized and one is not capitalized. So now the distribution of the finance cost to be capitalized and the expense out based on the IFRS 16. Based on IFRS 16, we will not go in detail the what is the standard is saying. So you guys go through and understand if IFRS 16 saying this cost is expense out, it will be the same year expense out, and some expense cost will be capitalized, so it will be part of the asset. Now here we have to see the deductible only the amortized interest card cost, not the total interest cost incurred. So in that, the finance cost will be go in the balance sheet. And if the asset life, let's say that in 10 years, so the 10 year, the original cost of the asset plus the finance cost will be amortized. So we will distribute over the life of the asset. So every year, the two element will be coming to the PL. One is the original cost of the asset and second is the interest. So these two elements will be coming into income statement, and actually this is the interest. This is not the original cost of the asset. So if this is the interest and is coming amortized, so in the relevant tax period, so whatever the interest cost coming in the profit and loss, that will be part of the interest capping rule or no? The interest cost, this is amortized, and the share over the 10 year and the current year amortized cost came to the profit and loss as a expense. So can we take this interest cost also in the part of interest capping rule calculation or no? I appreciate your quick response. I'll quickly respond on that. We so far have the very detailed understanding. We discussed the number of time. I am expecting the good response from you guys. Your understanding must be the clear so far. Yes, Mr. Umar, Hamza, Adnan. Yes, Ms. Kinjal, yes, you are right. It will be part of the interest capping rule. And I appreciate, Ms. Kinjal, if you volunteer yourself, and I will unmute yourself and explain this point. Ms. Kinjal, please unmute yourself.
Hello.
Yes, please.
Yeah. So as per the presentation, it is written as it is deductible only the amortized interest cost and not the total interest incurred. Means whatever interest we have capitalized as part of asset, that will be allowed as a interest reduction, and that amount we need to consider while calculating the interest capping rule.
Yeah, that's fine. But here the point, the participant is not able to understand what is the concept we are discussing. So this concept, can you explain with the example what we are discussing?
Yeah, so we are discussing there are two types of interest. One is regular and one is interest on the capital asset. So whether we need to include this interest on capital asset, whatever we are amortizing, that will be a part of interest capping rule or not. So as per the Article 29, that interest we need to include as a part of interest capping rule.
Thank you. Okay, guys, let me try one more time. I'm just bear with me because I'm writing with the mouse. So let's say the building that we construct. $1 million. The building that we construct, this is the construction building. So we taken the loan from the bank. We taken the loan from the bank, and let's say the $500,000 we borrowed the money from the bank. And the finance cost, see here, I'm just trying to explain the concept. Exact calculation maybe we're not able to complete in this example, but the concept you will understand. Let's say we paid the, and I appreciate if you guys do the calculation for the same. Okay, now we have the three line item. One, the building that we construct, that total value is the construction original cost. This is the original cost of the building. What is the original cost without any finance charge? Without any finance charge, whatever the material and the direct cost at the part of that. So I'm just keeping the simple example. The original cost of the building is 1 million. Then we borrowed the money from the bank is $500,000, and on the $500,000 we paid 150,000 to the bank. Now this 150 to have the two factors. Now this will be IFRS. Now IFRS 16, what he's saying. I'm not going to discuss in detail the IFRS 16, that is not the topic, but I'm referring to that. You can go and study what is the relation over here. So here I'm splitting this cost into two. Now here we split the finance cost into two. So what we are saying, as per IFRS 16, this cost can be capitalized. And this will be income statement expense. Now the question, the most of the participant will be saying, why this is the expense and why this is the capitalized. So we mentioned this is the IFRS 16 guideline. And what is the guideline that I appreciate you guys go and study from your side, because in our session we are highlighting the IFRS impact, but we will not discuss in detail, only the highlighting purpose we are referring the relevant standard. So now we here, based on the IFRS guideline, we said this will be the capitalized. So now what is our building cost? What will be our building cost? Okay, let's 1 million plus 100, 1.1 million. So now this cost will be amortized over this cost will be part of this cost will be part of balance sheet, and we will split over the life of the asset. That we may assume the life of the building is 10 years. Life of the asset is a 10-year, it will go into the balance sheet, and this cost go in the same year whenever we are constructing the expense out, and the same year will be affected to the accounting profit and as well as the taxable income, subject to other compliances. Now every year we are dividing the 1.1 million. So now please give me the answer. If you divide 1.1 million, what will be the per year amortization and the depreciation? And what is the in this 110, what is the part of the interest and what is the part of the depreciation? Because interest will be amortized and the depreciation on the asset original value. So now the same concept earlier we are discussing, because the capitalized finance cost, now we understand what is the capitalized finance cost. Yeah, 110 is a total depreciation. But if you understand the concept that we discussed, here is only the 100K is the depreciation. Plus 10,000 is the amortized interest. Yeah, please write and appropriately. 100 is the depreciation plus 10K interest amortized. So now if you understand this point, so I hope this concept will be clear to you guys. This is not very easy and this is not very commonly people understand. And most of the people may be not aware also about this. Thanks, Mr. Atik. Thanks, Mr. Atik.